Thanks, Dan, and thanks, Matt, for joining us again just after the Thanksgiving weekend.
Thanks for having me.
Hope you had a good one.
I did. It was long but short. I hope you had a good one as well.
Same thing, and yeah, it felt the same way.
Yeah.
So September was a bit of a volatile market. So can you just explain to people what the difference is between volatility and risk?
Yeah, so when it comes to investing, often people think risk and volatility go hand in hand. However, we like to think of them as two separate things. A risk, for example, is running out of money or not achieving your goals. Whereas volatility is just the amount your investments might fluctuate over a period of time. An investment portfolio with more stocks than conservative investments like bonds and GICs will likely have more volatility. However, if managed properly, the stock portfolio can actually reduce the risk of you not achieving your goals over a period of time.
So with that being said, Matt, what should someone consider when investing their money?
So the two most important factors, I think, would be time frame and your ability to handle volatility and fluctuations in your investments. If a person has a long time frame to invest, in theory, they should be more aggressively invested in stocks. For example, if a person invested $10,000, say 20 years ago, into the top 60 companies of the Toronto Stock Exchange, over that 20-year period, that $10,000 would have grown to about $50,000. That's a 400% rate of return. Now, if a person invested that same $10,000 20 years ago into a GIC, say the GIC was at 3%, that $10,000 over that 20-year period would have grown to about $18,000. That's about an 80% rate of return. Total rate of return over that same 20 years. But the stock markets have regular declines of 5 to 10%. And in cases like 2008, 2009, the stock markets went down somewhere around 50%. Early last year, when the pandemic kind of started, February, March, the stock markets went down over 30%. So that's where a person's ability to handle the volatility and the ups and downs comes into play. Regardless of a person's time frame. If they just can't sleep at night with large fluctuations of their investments, then they might need to reevaluate their portfolio strategy and their financial plan.
Are there any strategies to help reduce volatility or risk?
Yeah, one of the, if not the most important strategies, I guess, would be diversification. Diversification is very important, regardless of your time frame. You can reduce overall risk and volatility by diversifying your investments. If you have an extended time frame and can handle the volatility, investing more in stocks, but diversifying those stocks in different geographical regions, different sectors, might be the way to go. But if you have a shorter time frame or you're just more conservative and you're not comfortable with the ups and downs, having some stocks in there, but also diversifying further with some more conservative investments like GICs and bonds. Regardless of that, a person also should consider always having enough cash on hand for an emergency fund, whether they're aggressive or conservative, and for short-term needs and the what-ifs that might happen. It's also very important to talk to a certified financial planner. This is what they do. They can help you figure out your goals, your time frame, and try to figure out what the right investment strategy is for you.
Great. Thanks very much for the advice, Matt. Back to you, Dan.